Folks, welcome to a post-trade review of Contrarian Daily Regional Bank Bull ETF. This is a leveraged ETF, symbol DPST, traded on the Amex. What you're looking at here is an annotated chart through to March the 7th of 2018, which is when we went long of DPST, 200 shares at $92.50 per share. Now, why did we buy DPST on this particular date? Well, keep in mind that it was on our watch list. We knew that the revised Dodd-Frank bill was making its way through Congress. It would easily pass vote in Congress. It was a bipartisan amendment, and it would favor the regional banks in particular. Also, the Federal Reserve was quite hawkish on the U.S. economy with interest rates rising and the promise of future rate hikes forthcoming. What does that mean? It means that the NIM, net interest margin, of the banks would expand because of the rise in interest rates. So that's bullish. So the headline risk was favorable. The projection for consolidation in the industry due to the amended Dodd-Frank bill was also favorable and still is actually to this day. And when you take a look at the technicals were setting up outstanding. RSI formed a higher low, double bottom setup from the prior low, and it broke out of this bull flag formation. Stochastics, same deal here. Higher low, double bottom setup on Stokes. They rallied, pulled back, another higher low, and they broke out yet again. So on March the 7th of 2018, the shares broke out above resistance and they appeared poised to close there after putting in a bullish key reversal the prior day, a very strong price performance over the past 4 trading days. And we closed above resistance, not one resistance level, but 2 to close at a new all-time high. Add to that, volume was rising. This is what I always teach members. Watch your volume bars. If you're seeing breakouts on rising volume, it's very, very bullish stuff. So we put in an advanced order to buy 200 shares DPST at $92.50, and thus by the end of trade on the 7th, we were long of the regional banks. Now, this was an opening position, and this is where many traders make a mistake. They buy 100% of their intended allotment of shares on the breakout. You can never be that confident to do that unless, of course, you are an extremely proficient day trader or swing trader and you will abide by your stops. Me, I prefer a different approach, and that is opening up a small position and then adding to that position as the markets validate that our original opinion of the shares was accurate, and then we would add on pullbacks and then continuation breakouts. So it's a far more disciplined and deliberate approach to building a position. So this is how the chart looked. End of business on March the 7th. All was good. All was right with the world. Nothing can go wrong, right? Because we had headline risk, favorable. The economy, all the economic reports were coming out favorable. Yields on the 10-year, favorable. That would benefit. Margins, favorable. The chart, outstanding, looking great, institutional demand. Fast forward to March the 14th. Here's where we opened our position on the 7th. We had broken down the following day, but we retested support. It held, so we held. Remember, we only had a small opening position, and the game plan was to buy on a continuation breakout after a brief consolidation. So we pulled back on the 8th, retested support on the 9th. We rallied, and then we had a bullish key reversal. We gapped up. So the trade was still good. We were happy. All was right with the world. Until, of course, the 12th, when we flashed a bearish reversal day. That's not really something you want to see. So many times you'll get a pullback and a retest of a support level, which we got. But we actually already had that here, and it failed on the 8th. We had it again here on the 9th. I don't think traders needed another retest of this support level. So a yellow flag went on the track for me anyway, and on Market Wrap, which I sent out to members, which is our after hours discussion of the day's events and a recap of our strategy of positions and watch stocks. On March the 14th, I said our game plan with DPST, given the warning flags that the market was sending us on the charts, was that if we put in a new daily low, we would stop out of our position. If we didn't make a new daily low and we proceeded higher, excellent. However, if it didn't, we would stop out and protect our capital reserves. And many times I'll state to members and the public alike, losses are good. Losses are profitable. How can that be? Losses are only good when you keep them small and you preserve your capital reserves. As Gordon Gekko said on Wall Street, you can't piss in the tall straw with the big dogs without your capital reserves. So how do you make money on losses? It's because when you protect your capital reserves, you reduce your opportunities lost. What does that mean? It means two things. One, if you're wrapped up in a trade for too long, a losing trade at that, there may be other opportunities out there that you could have taken advantage of, but due to the fact that you are wrapped up in a bad trade that you should have stopped out of, well, you can't take advantage of that trade. Or two, suppose you finally do decide to stop out of a bad trade, you allowed a small loss turn into a big loss, but you don't have the capital reserves now to take advantage of an excellent opportunity. Well, then, that's another example of opportunity lost. Now let's review how we managed the trade and run through some scenarios. On March the 14th, we stopped out of our position at a loss of 1.4% or $260. So a reasonable loss to accept. Now, had we closed out the day and taken our loss at the close, which was $87.93, we would have seen a loss of 4.9% or $914. So we saved ourselves a good amount of money by using the strategy that we did. Our loss was $260, and had you stopped out at the lows of the day, it would have even been worse. But I'm going to use conservative numbers. I'm going to use the close numbers. So the loss would have been $914. Now let's just say we didn't stop out on close on March the 14th. Let's walk through that scenario. Here we are, present day. Now, if you didn't stop out here on March the 14th, in all probability, you weren't going to until you got your money back. And when you get into that mentality, you're your own worst enemy. You are now negotiating and managing and rationalizing the trade within your own head. You are hoping when you should fear. So the shares consolidated for a couple of days. I would have re-entered had we broken out above this upper band of resistance and closed back above 92.50. However, it did not pass our test and the shares broke. And they broke really hard. Now, if you had awoken on March the 27th when they broke, the amount of stress and anxiety and disappointment in yourself would have been dramatic. And it would only increase on March the 23rd when we broke down to a low of $69.82. Remember, we stopped out up here at $91.20. Within only a few trading days, we were down to $69.82, but it only gets worse. Had you held and finally capitulated and stopped out on April the 2nd, which is our most recent low, you would have realized a loss of 26% or a loss in dollar terms of $4,810. So when our loss is good, when you stop out as we did here with a loss of 1.4%, which doesn't feel great when your stop loss order gets executed, because the question of was it the right decision haunts you for the next couple of days. However, I can assure you that when you see continuation breakdowns after making a wise decision, your confidence only grows. When you hold on to these positions and allow a small loss to turn into a large loss, it destroys your confidence and you continue to make bad decisions, perhaps even adding to a losing trade. Now, how do I know all this? How do I have all of this insight? It's because I have been there. Believe me, folks, when I began trading the markets, there were plenty of times when I was in a world of pain like this. But you learn. You learn to keep your losses small. And if you keep your losses small, you can be wrong 5 or 6 times out of 10 and still be profitable as long as you allow your winners to run. So I hope you get some value out of this commentary, this post-trade review. Most of my competitors love to talk about wins, and they never talk about losses, but there's a lot to be learned from your losses. Sometimes it's very hard to look in the mirror and say, you know what? You took a loss. Let's review it. Was it right? Was it wrong? Jot down your notes in your trade journal, and you move forward. Now, in the case of DPST, as I'm recording this now, it appears as though we are going to break down to new lower lows. Very bearish price action on the 13th of April. So we'll see in the coming days. But hoping to get back to even is not a strategy, folks. Keeping your losses small is a strategy. If you get any value out of this video, please leave a comment. If you're watching this on YouTube, follow me there. Click that bell so you get notified of future commentary. If you're watching this on the website, enter your email address. We'll send you out a couple of free trade tutorials, as well as our best stock charts video, which comes out each Saturday. And we hate spam too. You will not be spammed. Everybody have a profitable trading day and week. Be well.